Hey folks, my name is Jeffrey, and this is probably my third or fourth time doing a conference here with the Festival of Traders. Just a quick bit about my background, if you've never heard of me. I have been a software developer most of my adult career, and so I go way back on the West Coast, developing all kinds of accounting systems for Fortune 500 companies, that type of thing. Ran a software company that I started for about 15 years, and I gradually shifted over to developing software for the markets, and it just became kind of my passion. And so I basically shut my company down and focus solely now on development for the markets, well, swing trading, day trading, the futures, that type of stuff. And so I go back many, many years with coding and software development and AI and all that kind of jazz. All right, so today what we're going to do, my topic is like new concepts in day trading the Emini Futures. And in today's little webinar here, I'm gonna show you some really cool new things that I've had under development and that we are currently making available for folks to trade with. But what we need to do is just go and do kind of a brief and quick review of what the futures is. If you're a person that's not familiar with the futures market, if maybe you've day traded stocks in the past, or you're wanting to day trade stocks, and you might want to take a look at the futures too, because there's some distinct advantages that we can talk about. I day traded stocks for 10 years and loved it, but when I found the futures market, I saw the clear advantages, so I shifted over to it pretty quickly. The futures market is made up of different symbols which represent the different markets. So we have the ES, which is the S&P 500. The NQ stands for the NASDAQ. YM is the Dow. CL is oil. The DAX is a European market. We don't have that symbol anymore. We put the 6E in there, which is futures on the currencies. The Emini Futures, we trade contracts instead of individual shares. And when you take a look at how the futures market works, you'll see this is a great simplification, because we don't have to worry about, if it's a cheap stock, we buy 1,000 shares, and if it's an expensive stock, we buy 10. We don't have to do any kind of math like that because everything is fairly static. So you can start off at one contract and then work your way up to 2, and everything is relative. We trade in points and ticks versus percent. And so this is another thing that helps simplify day trading. When you're day trading stocks, again, because of the price differentials, if you have a really cheap stock or real expensive stocks, you've got to do some math to figure out, well, what is this 5% move on this stock and what is a 10% move. And then every stock has got its own average range, which goes into the mix. And then you kind of have to compute different maybe targets based on the average range of the stock you're trading, right? So day trading stocks, it can be done. I did it for a decade, but you've got these complications, extra complications. Whereas the futures market, we trade in points and ticks. And again, everything is static, right? We can say, okay, on this symbol, your first target is like 1 point or 2 points. And so we measure things in points and ticks, and we don't have to do computations for percent. The other thing that's really great about the futures market is it's just as easy to short the market as is to go long. So now you can short stocks, but it involves extra legwork, and there are certain stocks you can't short, or it's very difficult to short. And so the futures market, it's piece of cake. It's identical, just mirrored in a different direction, right? Long, short, whatever the market's doing that day, we play. We play long, we play short. You're going to find no extra difficulty. The futures market is also, I have on here 24-hour market. It's really a 23-hour market. There's a little bit of shutdown time. And then it's 6 days a week, basically. It opens early on Sunday. So you've got a lot of exposure. Doesn't mean you want to try to trade every single hour of it. There's actually 2 sessions that are great, the US day section and then the London Open, which runs through the night. And those are basically active sessions. So you can trade the futures market at night. The other thing is that you can start your account fairly small relative to a stock market account because you have incredible leverage built into the futures market. So you can start an account with a couple $1,000s, and it's almost like you're working with $50,000, right? Now that's a double-edged sword, as I'll talk about, but there you go. So this is just a brief overview of what we have in a little bit different in the futures market. Now, just to give you a quick example of some of the futures you can trade, and just to for the rest of the webinar here, to have some of these numbers in your mind, so when you look at some of the charts and stuff, you kind of see what we're doing. In the ES futures, for instance, the S&P 500, so 1 point in that, so that's 4 ticks, 1 point equals $50, right? And so we can shoot for targets of 1 and 4 points, right? And you can do the math on that, right? Our stops roughly are in between 2 and 4 points, depending on the type of strategy that you'd be using. So you can see you can do the math on your risk there. We can look over at crude oil, for instance. Crude oil, the CL futures, trades in pennies, and it's $10 a penny. So some scalping targets would be 10 cents and 25 cents. You can do the math on that. And you can see the stops down here. And then if we take a look over the YM futures, that's $5 a point. And you can look at some of the point targets that we work with there. The NQ, we have the NQ symbol as well, and you can kind of see we have calibrated out 5 points, 10 points, 15 points. These are high frequency targets that the NQ will move during a day session. And when we take individual trades, we can set up kind of semi-complex, or not overly complex, trade setups where we go in and we scale out over several targets. So here's a standard type of what we call an ATM setup, which stands for automatic trade management, where we'd go, let's say we were trading 4 contracts, we'd go for 3 ticks, okay, 3/4 of a point on half the position. And we start out with a narrow stop, and then as soon as we hit that first target, we'd be able to tighten our stop even a little bit, but not even be at an entry, but we'd achieve what's called a virtual break-even state, right? And then we can let the market run and go for these bigger targets. Now, one of the big things that recently happened several months back, which is great for basically everybody, but great for the new trader, is the CME introduced the new micro E-minis, okay? So they're basically 1/10 the size of the regular contract. So in other words, with I showed you on the one chart, the ES futures, 1 point is $50. It's $12.50 a tick. So 1/10 of that on the ES micro is $5 a point and $1.50 per tick. So now I'm going to show you why these new micros are great, because one of the issues we have with the well, let's talk about the commission comparisons real quick, just so you can get an idea. This is right off the Ninja platform. You can get as low as a regular contract for the ES or the NQ or the YM, you're paying $1.89 round trip per contract, okay, for commissions. And that's static, right? With different brokerages and different share amounts when you're trading stocks, you have all these different configurations of what the commissions are going to end up being for you. But you can get down to where you just have a static commission. And look at the commissions on the new micros are great. They're 41 cents per direction, so it's be 82 cents round trip, right? And so the commissions are not as efficient. And what they did is they dropped the leverage down 1/10, but they dropped the commissions down 1/5. But hey, that's okay, because it's still, these commissions are totally reasonable. And all you do is you work with the micros until you build up the size, and then you go up to the regular size contract when you reach that level, and you can get a little bit more efficient commission rates then. Okay. Now, what I was going to say is, one of the great things about the micros is that for a new person, you know, the big allure of the futures is the built-in leverage, right? Incredible leverage. If you can catch runners, you'll be amazed at what that translates into gains. However, it's a double-edged sword, because you can also take quick hits. So new traders that come into the futures market sometimes, you know, rush things or get overwhelmed, and with the leverage, you can easily wipe an account out, right? So the drawdowns can be pretty big for an inexperienced trader. The new micros make the stop outs that we use mosquito bites in comparison. So you can get in there even with a smaller account, someone starting off, and you're not going to fear trading. The drawdowns are very reasonable and controllable. And again, then what you do is, to increase the gains, we just increase the number of contracts we trade. So let's continue on here. Now I'm going to cover you know, basic theory. And these are all kind of my opinions, but you know, they kind of run alongside with what maybe you've read before. The market is about 70% technical and 30% news driven. All right. And so what that means is, if we don't, in the absence of news, we typically will have a market that is respecting support levels or resistance levels, right? Supporting trend lines, that type of thing. But when we get a news catalyst that comes in, it's either negative or positive, then we can see the market just bust through all of the technicals, right? So if you've ever looked at a chart, a live chart, and you see all this heavy resistance overhead or whatever, and you're sure that the market is going to, you know, get deflected down off of that, and then all of a sudden the market just climbs right through that like a hot knife through, you know, warm butter. That's probably the news catalyst that's driving the market. They're just, no matter what's in the way of the price, it just rams right through it, right? So, and at any given time, we get mixtures of, you know, certain amount of news and certain strength of the technicals. This is one of the things that makes the, you know, study of technical analysis a little bit more complex, a little bit more difficult for folks, because we have this constant morphing between the news and the technicals. Right? But in the end, you know, we can develop strategies that work in these kinds of trading environments that we get. Now, the other thing to keep in mind is, when we come up with any kind of a trading strategy, whether it's, you know, long-term swing trading or intraday day trading, we really have to focus in on three important things: that, you know, the proper calibrations and the, you know, proper setup is going to make a big difference, right, with how this strategy pans out. And so we're looking to always get as precision entry points as we can. And what does that mean? That means that when we pull the trigger to get in, we'd like the price to get going in our favor as quickly as possible, right, and get going away from where we have our stop, not the reverse. We don't want it to start going towards our stop right away. We want the trades to go, you know, in our favor as quickly as possible. This is where the precision entries come in. Sometimes it's a matter of just waiting an extra 30 seconds, right? And then pulling the trigger and getting in, and there's a world of difference with the price action. So it gets down to that level of kind of precision. The other thing is precision stops and trailing stops. If we have our stops too close, we just get knocked out with a loss, and then we will end up seeing price go in our favor, right? I'm sure everybody's seen that happen to them. The other thing, you know, you could be in a really great run, trending directional move in the market, and you get your stop too tight and you get knocked out just halfway through the big move, and it's so strong you don't see another good entry point, right? So the you know, precision of the trailing stop and the initial stop are key to be able to squeeze out and stay in the market as long as possible in our winning trades. And then another thing is precision targets. And there's two ways we can look at this. One is we can actually pick static targets where you move a limit order up to, and when the price runs through that target, you're out, right? Now the downside is you could have a price run that just keeps going, right? And you took it out too early. So that's just one of the cons of picking targets. So the more precise you are, what you'd like to see is where you have a target, and when price runs through that, basically that's the end of the move. Okay, that would be the ultimate goal. The other way we can do profit taking in day trading is, instead of picking a target, we can have really precise trailing stops that get us out with the maximum move based on the trailing stop, right? And that way, let's say you were wrong on your target and the market goes twice as far, the trailing stop would have kept you in for that extra. So you see, we got these different ways we can mix and match our different trading strategies within the setups that we're using. The combination of how we put these together is what results in the type of smooth equity curve that we're going to see in our trading account. Now, when we're talking about system development, strategy development, that type of thing, it's important to realize that every single rule that you can come up with has a negative to it at some point, right? So there's a pro and a con to everything that you build into a system, and it ends up like a Rubiks Cube. You can find one thing to try to improve, but when you tweak it, it lessens something else in the strategy that causes a loss somewhere else, back in the future or back in the past or in the future. And so everything just, the gains and losses just shift around, but you don't have any improvement. And so this is one of the big challenges to system development is, this is where the optimization comes in. You've probably heard of over optimization. That's where you go overboard on trying to make things work too good. And so basically, our calibrations and our configurations, our trade management, the way we put it together ends up resulting in either a really good winner or mediocre stuff. Everything is a double-edged sword in the strategy development. Real important concept in trading is that we win over the series, right? So in other words, and I always use this extreme example, you're not going to take your entire bankroll and just bet it on your very first trade ever and that's it, right? That'd be, you'd either win or lose, right? Everything. And no, we spread it out over a long series. And so the edge that we develop in some of these strategies, because remember I alluded to the fact that the market can morph around with the news and the technicals, and we can get odd behavior. If you watch the market today, we had a real zigzaggy market early on in the session, move to the upside, move to the downside, back to the middle. This market was all over the place, right? So we had technicals and news kind of mixed in today to gyrate the market all over the place. So our strategies will succeed handsomely on certain day types and then not perform so good on other day types, right? But it's over the long series that the edge gets built in. So the reason this is such an important concept to keep in mind is because as a new trader, when you adopt a trading strategy, you have to push through the series and for the edge to kick in and give you the gains, right? It's not a cakewalk where you come in and score big every single day. It just doesn't work that way. We have really crappy days in the market, and we have really great days in the market, like shooting fish in a barrel. So, but it works out over the series. And so the reason I'm honing in on this is because one of the big issues with new futures traders was the leverage I was talking about. If you start trading a live account and you're trading off of the full-size contract with the high leverage, you could experience some pretty big drawdowns that could scare the bejesus out of you. And because you're looking at a couple $1,000 account and you're losing $500 a day, that eats things up quickly, right? So the new micros lessen that kind of drawdown up front and allow the new trader to be able to come in and push through that series to really get and to be able to see how you have the edge over the trading series. What I mean by that is you got to come in and you might take several trades a day, and that has to be done over a month to really see how the edge kicks in. All right, I can talk more about that. Now I'm going to kind of go quickly because I got a lot of good stuff, but I'm watching the clock too. Another concept that you want to keep in mind is get away from the concept that you have to trade a lot to make bigger gains. That is the wrong approach. That's the approach that's you're gonna get eaten up in commissions and you're gonna be all over the map. It's better to focus in on one kind of a strategy that you can hone down into a kind of a consistent gainer, again, over the series, and start really small. And the great thing about the micros, you can come in and start with one micro contract, have no fear to pull the trigger, just go through the series, get through the learning curve, and you'll be fine because the drawdowns will not wipe you out with the new micros. Then as you see the advantages that you have with the strategies kick in, and I'm just talking about any kind of strategy in general. You know, if you can find a strategy that shows good gains and results over the series, then you just start increasing the size of your contracts. That is how you make more money in the market, not by trading more. Right? So if you had a strategy that maybe you did 2 trades a day, well, to make more money, you just gradually over time increase the number of contracts. Now, real quickly, the 10 when you get to 10 micro contracts, that equals one of the regular size contract, right? Because it's a 1/10. Okay, so let's talk about this real quick. We have the 6 deadly sins of trading to avoid. One is over trading, revenge trading, and this is such an easy trap to fall into, and I'm going to guess this is one of the #1 ways folks wipe their accounts out. You come in and let's say that you said, okay, my max drawdown I'm going to ever accept is going to be $100 during the day. Okay, you don't even need to do that with the micros, but let's just say if I hit $100 drawdown, I quit, right? So you're doing a bunch of trades, and maybe you're already over trading. You're 10 trades in, and you're down like close to $100. But you got to get that back. You know that if you can just hook into a good mover, good runner, you'll be able to get it back. So before you know it, instead of quitting at your, with 10 trades and your drawdown limit, you're 30 trades in with all the commissions and you're $300 down, right? Easy thing that you fall into, all right? Trying to revenge trade. The best thing to do is you quit, you come back another day. What it means, if you hit that kind of a limit and that many trades, let's say, that means the market is not working that day. It just doesn't want to be your friend, right? So just come back another day. The market morphs, hot markets, cold markets, and so it's just a matter of coming back another day. Another little sin is trying to mix strategies all the time. Trying to focus on too many setups, and there's folks that are out there that have 57 different setups they teach, and it's just way overkill, way too complicated. And the other thing is taking pot shots, where maybe you get bored or you see market kind of take off and you go, "Ooh, I can just jump in and catch this." Bad thing to get addicted to. Attempting to only scalp trade. That means that you're maybe a nervous Nelly, and every single trade you do, you just want to try to get 1 point, let's say. Not going to work out for you. You got to get into some trades that move a little further and catch some runners, because the runners have cleanup commissions. If you do a 1-to-1, if you have a 1 point stop out and you're going for a 1 point target all the time, you have to have such a high win ratio, and you can have a day where nothing works for you. So starting with positions too big, this is another thing. People come in and they, maybe they have beginner's luck their first day, and they're like, screw the rules, I'm going all in, and the next day is horrible, and they cut their account in half. So again, the best thing to do is start off extremely small. You can do that with the new micros, 1 contract, and you just scale up. Fighting the trend, counter trend trading. Now this, there are times that there are some nice counter trend trades to take, but for the most part, and I used to be a super mega counter trend trader, and lo and behold, on a super trend day where I could have just dropped a couple contracts in and went back to bed and made a fortune, I was over trading, trying to scalp the market against the trend and didn't make any money, right? So go figure, and paid a bunch of commissions. So it really behooves most people just start off and work with, trying to play the trends. And the stuff I teach you really focuses on how to see these trends and stick with them. And then finally, trading with original capital. And I'll go into this real briefly. If you've got a $5,000 account, don't trade off that capital, right? Because if you take some initial drawdown, now your account's 4,800, and then 4,600, and then all of a sudden you're getting gun shy, and you have fear to continue on because you just see your account shrinking. Plus, you're losing trading power. So a great concept, and I have a full-length video on how to do this plan, is you always just send in a little bit of extra risk capital on top of your base original capital. And with the new micros, it's great. You can send in a couple $100 and that's your risk capital, and you just trade away and go through the learning curve, never even get close to your original capital. No matter what happens, you can quit and the original money that you put there is still there. Okay, now I got to go quickly here because I'm watching the countdown timer, but I put too much good stuff together. Let's go briefly over the different market day types we see. One of them is a stair-stepping market. This is where the market will open and it kind of pushes higher to a certain level and gets into congestion, and then later it pops again. So it's like going up, stair steps. We have it to the downside. This is a market that if you have the right kinds of signals on breakouts and things, you've got all these entry points all during the day as the market moves higher. This is a trending market, but it's a very stair-steppy market. Another kind of a day type that we get is a very cyclical market. This is where the market might swing wildly one direction and then go the other direction. And guess what? This is the day type we had today. Exactly. Ran to the upside first, then we ran to the downside. And then we get spiky markets that shoot up, all up and down, and maybe they go into a trend for a certain while and that fails and we go all the way back to the opening price. So we have these different market flavors to deal with. One of the other things we get are the long range days. These are the days, like if this was the daily bar, we'd see the market open at one extreme and close all the way in the opposite extreme. And these are big, these can be big point gain days if we can catch and stay trading in these days. All right, and so now let's get in, talk real quickly. How much time do I got there, Dave? I should have like 10 minutes.
10 minutes.
Okay, great. That's all I need. So what I've done to work with the intraday futures market is I came up with this concept about 5 years ago and developed it into a software program. And I came up with this concept called the dynamic trigger range. And what it does is it creates a range around the price, okay, on our futures contracts, and everything in the middle is noise. Okay, and I originally came up with this concept because I was just trying to figure out how to develop some certain noise suppression algorithms. And what I discovered is that, yeah, this dynamic trigger range does sandwich the noise and the congestion real well, but when price is able to get out of that is where we see big impulse moves occur. Right, so it was a little bit of an accidental discovery that it turns out that not only does this just tell me where the noise is, but we get great trading signals on the breakouts. Okay, really fine-tuned trading signals, and this is much more advanced than your typical Bollinger Bands or Keltner ranges or anything like that. So what we work with then is on our charts, you can basically just plot the high of the dynamic trigger range and the low of the dynamic trigger range, and you have visual reference points on what the price is trying to do. And so when you see price break out of the dynamic trigger range, you can attempt to play that move. Now, over the years, I have developed an entire piece of software and a back-end automated system that sends out these dynamic trigger ranges for all of the different symbols. And so we're 5 years into this now, and so we've got quite a sophisticated system. You get entry alerts, you get macro targets, trailing stops. There's a market meter that shows you the strength. System notes go through. You have directional arrows. You have all kinds of stuff. You have the average volume going through. And really cool feature is we've got a settings screen where you can go in and check and uncheck the different tabs you want. So you can customize the piece of software to only display the symbols that you're interested in trading. Now, along with that, for the Ninja platform, we have it for both Ninja 7 and 8, we developed on-chart indicators that basically get the same signals right through the software and plot it on the chart for you so you don't have to drag the lines around. All right, and so what that does for you is it automatically generates the dynamic trigger range and moves the dynamic trigger range around for you while, you know, right on the chart, and then you can trade off of those levels. Now, right now, or for the last couple of years, we've had 2 different algos running for all the different symbols. We've had the Power Scalper, which gives lots of alerts through the day, and it basically shifts direction at will. You get lots of singles, doubles, and triples, quick trades throughout the session. And then we have another type of algo that is called the Momentum Breakout, and it's trying to give you the major alerts of the day to catch the big long range days. So you basically attempt to get a position early on, and then you try to stay in that position for as long as possible. Now, we use real simple triggers, and here's an example of one. On one of the algos, you basically just you use a regular old bar chart with a 1-minute chart, and we're just looking for a 1-minute close past the trigger line, and then you're in, right? You can follow the different rules we have for the trade setups. You can see here's an example where we had a dynamic trigger range on a 1-minute chart, and then right in here somewhere you'd take an entry, and you can see the follow through. The breakouts of the dynamic trigger range tend to run into the impulse moves. Now I'm going to have to skip ahead because I want to just show you one final thing here. I probably got about 3-4 minutes, so I want to show you one of the newest things that just came out. And this is, you know, the title of this is New Concepts in Emini Day Trading. This is a really cool concept. A few years back, I had a friend of mine send me a video of that he came across where somebody had come up with this secret magic formula that basically could pinpoint the exact minute the market was supposed to change and direction. And basically the story was that he had, you know, there was some entity, secret entity that controlled the markets, and he discovered their secret, a bunch of hooey basically. But later it got me thinking, like 6 months later, it got me thinking, I wonder if there is some kind of rhythm to the markets, you know, a timed rhythm. So I actually developed a bunch of analysis software to analyze that, and I analyzed minute charts, I analyzed volume charts, I analyzed range charts, and I used pivot highs and pivot lows, and basically ran a whole series of back tests over 10 years of data. And lo and behold, I found that there is a timed rhythm in the markets, okay? And this has nothing to do with anybody controlling the market. This is probably just a natural rhythm, but the natural rhythm is between 18 and 24 minutes, all right? And what we get then is we get increased directional price movement in that range. So what that means is, let's say in a 30-minute period, we're basically saying we're being able to narrow down a 10-minute period then where we would see the action occur. Now, what I did then is I created a special micro algo that works on a really fine-tuned, like a micro level, and it works right in that range of between 18 and 24 minutes. Now, according to my analysis and research, I found that most of the breakouts occurred 2 to 3 minutes after that window started. So that puts us at right around 20 minutes. So what I did is I created a new algo that I call it the micro range trading at 20-minute intervals. That means that every 20 minutes on the dot, on the clock, a new range is going to get set up. And because of this natural rhythm that occurs between like 18 and 24 minutes, we're going to be able to catch nice moves in the intraday session. And it's one of those things, it's a natural ebb and flow of the markets. I don't think anybody's like controlling the markets or anything, but it just works great. And this opens up all new possibilities of tighter stops all right, so the three big advantages to this new 20-minute algo are it gets us to focus in on the periods of higher probability action, which because we narrowed it down to that 18 to 24 minute slot. We get to trade at the micro precision level. We can have tighter stops and get more precision entries, get the trades moving in our favor quickly. And the greatest, and I think the coolest thing about this whole new algo is you can set your trading activity to the clock. So that means you can, on your smartphone, you can have a 20-minute timer. You take a trade, you complete it. You got 15 minutes before the next trade comes through. You run off to the kitchen. You go, take care of some business, whatever you have to do, and you know exactly when to come back and sit down for the next trade setup. And it's a kind of a revolutionary thing. I don't know anybody else has this kind of a concept, and it really works great. Imagine that then you're not glued to the screen all day long just waiting for the next setup. So this is our alert software, a state-of-the-art alert software. It's desktop alert software. It's platform independent, which means it doesn't matter if you're in TradeStation, Thinkorswim, Ninja, it doesn't matter. You can install this. It's its own software. You're going to get all the alerts, targets, trailing stops, that kind of thing. You can pop over to our webpage, poweremini.com. You can read more about the alert software, see how the indicators work for the Ninja thing. We've even got a little freebie PDF in there. There's a blog post you can read. I've got a ton of blogs, articles in there. You can read more about the futures market. And if you have any questions, you can email us at info@investingsystems.com. We'll get back to you. All right, and so, sign up today, start trading tomorrow. It's $99 a month to start. There's no long-term, agreements or anything like that. You sign up for a month. If you like it, you stick around. If not, you can cancel and you are not billed again. Ninja Trader users get the on-chart companion indicator at no extra charge, included with the regular membership. So that's it.